First, I'll open with a clear warning about a scenario many families are considering. An adult child takes out a new mortgage to buy their parents' home as a bailout. Next, I'll set expectations that will unpack the hidden risks, the loss of first-time buyer status, landlord complications, legal and tax pitfalls, and safer alternatives. By the end, you'll know how to avoid a long-term financial trap and where to get proper advice. To guide you through, here's our roadmap. First, we explain how the arrangement usually works. Then, we reveal hidden costs and tax consequences. After that, we examine the landlord obligations and family stress it creates. Next, we run through a quick case study with realistic numbers. Then, we outline safer alternatives. Finally, we test your understanding with short quizzes and wrap with key takeaways. Let's move into the scenario setup. Now picture this. Your parents are behind on payments or facing rising costs. They propose that you take out a brand new mortgage to purchase their home. It feels like the right thing to do for family. However, beneath the surface, this move can transfer substantial debt and legal liabilities to you, jeopardize your eligibility for first-time buyer perks, and tie you into a landlord relationship with your own parents. With that context, let's break down how this arrangement actually functions in practice. First, parents propose a sale to the adult child, sometimes at a discount, to keep the property in the family. Second, the adult child secures a new mortgage under their own name, becoming the legal borrower. Third, legal title transfers to the child, making them the true owner. Fourth, this immediately removes their first-time buyer status and access to associated incentives, such as stamp duty exemptions or government assistance schemes. Fifth, the child effectively becomes a landlord to their own parents, who are already financially strained. Sixth, if the parents' payments, framed as rent, fail to cover the mortgage, the child is solely responsible for the shortfall, default risk, and potential foreclosure. As we proceed, let's dig into the hidden costs this creates. Next, this mind map centers the adult child and radiates out to key risk categories. Financial risks include the loss of first-time buyer status, potential stamp duty costs, ongoing maintenance, vacancy risk, and foreclosure exposure. Legal risks involve landlord obligations, regulatory compliance, and the practical difficulty of evicting family. Emotional costs can include conflict, stress, and guilt. The parents' situation reflects unstable cash flow, unreliable rent, and mounting repair needs. Finally, lenders and regulators influence affordability assessments and amplify risk when interest rates rise. Taken together, these nodes show how the child becomes the nexus of financial, legal, and emotional pressures. Now, let's quantify some of those hidden costs. Here is a breakdown of hidden costs. First, losing first-time buyer status removes your eligibility for important reliefs and support schemes. Second, stamp duty or transfer taxes may be due on the transaction, creating an immediate cash burden. Third, as the owner, all maintenance and repairs, such as roofs, boilers, and plumbing, become your responsibility. Fourth, as a landlord, you may need landlord insurance, and to meet various safety and compliance requirements. Fifth, there is vacancy or shortfall risk if your parents cannot pay rent on time or in full, leaving you to cover the mortgage and any arrears. Sixth, interest rate risk means that rising rates can make payments unaffordable over time. Finally, the opportunity cost is significant because your borrowing capacity is tied up, delaying or preventing your own independent home purchase. With those costs in mind, let's compare the trap to safer alternatives. On the left are safer alternatives. Parents can downsize to reduce costs, refinance their existing loan if feasible, explore age-appropriate equity release products, or negotiate hardship arrangements with lenders. Independent professional advice should precede any decision. On the right is the trap. The child buys the parents' home, loses first-time buyer status, becomes a landlord to distressed tenants, and assumes default, repair, and legal risks. Over years, the administrative burden and stress can compound, while offering little to no financial upside for the child. With the comparison clear, let's move into practical steps you can take to protect yourself. Now, here are concrete actions. First, pause and avoid signing documents under pressure. Second, obtain independent legal and financial advice that is not arranged by the selling party. Third, speak with a broker to model your long-term affordability and borrowing capacity. Fourth, calculate total ownership costs and stress test with higher interest rates. Fifth, Thoroughly explore alternatives, like downsizing, hardship programs, or equity release. Sixth, if you still proceed, use formal tenancy documents and complete all safety and landlord compliance checks. Seventh, document exit plans in writing, covering payment responsibilities, repairs, and eventual sale procedures. Before we continue, let's test your understanding. Question: if you buy your parents' home with a new mortgage in your name, what happens to your first-time buyer status and related perks? Options: A. Nothing changes. You keep all first-time buyer benefits. B. You lose first-time buyer status and may forfeit related tax reliefs. C. You keep the status but only lose tax exemptions. D. You can reclaim first-time buyer status later with no penalty. You may pause the video now to think about the answer. Sections. We will discuss the answer in the next section of the video. The correct answer is B. By taking ownership, you typically lose first-time buyer status and forfeit associated tax reliefs. This can create immediate and future costs when you try to purchase your own home. With that clarified, let's add a formal disclaimer to keep this guidance in the proper context. Before proceeding, an important disclaimer. This video provides general educational information and is not personalized financial or legal advice. Regulations, tax rules, and lender policies can vary widely by jurisdiction and can change. You must seek independent, qualified advice tailored to your circumstances before making any decisions. With that in place, let's examine how money and liability actually move in this arrangement. Now let's visualize the flow. The parents propose the sale. The adult child applies for a mortgage. The bank approves and funds the purchase, leading to the transfer of title to the child. The government collects stamp duty or transfer taxes where applicable. Afterward, the parents pay rent to the child, who now owns the property. If there is any shortfall in rent, the child must cover the mortgage payments. In the event of default, the bank can pursue foreclosure. Throughout, emotional and legal tensions between the parents and child can escalate. With the flow clear, let's ground this in numbers with a brief case study. Consider an example. A purchase price of £300,000. Depending on current rules, stamp duty or similar transfer taxes could add several £1,000s. This is illustrative only. Suppose you borrow $270,000 at 5.5%, yielding approximately £1,540 per month on a capital and interest basis. If your parents can only pay $1,200 per month, you must cover a £340 shortfall monthly. Add annual repairs and landlord compliance costs that could range from £1,500 to £3,000. If rates rise to 7%, monthly payments might increase to around £1,795, further widening the gap. The opportunity cost is significant because your borrowing capacity is tied up, potentially delaying your own home purchase for several years. After 5 years, selling could involve agency fees, legal costs, possible taxes, and substantial administration, all for little or no net equity for you. Next, let's reinforce understanding with a second quick quiz. Question: as the new owner who is legally responsible for repairs, compliance, and covering any shortfall if the parents cannot pay rent? Options: A. The parents. B. The lender. C. The adult child owner or landlord. D. Shared equally by all parties unless otherwise specified. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. As the legal owner, you are responsible for repairs, compliance, and any shortfall in payments. The lender is not responsible, and the parents' occupancy does not shift liability away from you. With that clarified, let's also visualize how these risks stack up proportionally. This pie chart depicts an approximate distribution of risk. The adult child carries the majority, roughly 60%, reflecting responsibility for payments, maintenance, and compliance. Parents carry a smaller portion, around 25%, representing their ability or inability to meet rent. The lender carries around 10%, largely through underwriting risk and potential recovery processes. The remaining 5% is attributed to external forces such as regulators and market conditions like interest rate changes. With the risk distribution in mind, let's consolidate key points. Here are specific red flags, temporary arrangements that quietly become permanent obligations, reliance on verbal promises without written, enforceable agreements, incorrect assumptions that first-time buyer status can be regained later without consequence, failing to stress test for interest rates or vacancies, ignoring landlord legal requirements and safety checks, and believing that a future sale will inevitably make you whole. A useful rule of thumb is that if you cannot describe the exit plan in one sentence, you likely do not have a clear exit plan. With that caution, let's move to the final key takeaways. To summarize the essentials, purchasing your parents' home with a new mortgage can void first-time buyer benefits. You become a landlord to distressed tenants, introducing substantial stress and risk. You assume responsibility for maintenance, compliance, and default exposure. The off-cited future sale may not deliver meaningful equity to you after years of risk. Safer paths include downsizing, refinancing, or appropriate equity release options. Obtain independent legal and financial advice before acting. Now, let's close with a concise summary and your next steps. In conclusion, this bailout approach relocates significant debt and liability to the adult child, undermining future home buying power. Responsible alternatives exist that can support parents without sacrificing the next generation's stability. The next step is to pause, gather independent legal and financial advice, and compare all options with a clear exit plan. Finally, let's end with a quick thank you and a call to action. Thank you for watching. If this was useful, please like the video, share it with someone who might need it, and subscribe for more content on making safer money decisions. Share your experiences or questions in the comments so others can learn from them, and we can cover them in future videos.